In 2020, more than 10 million new stock brokerage accounts or trading accounts were opened, and trading apps like Robinhood saw an increase of 5 million new users between 2020 and 2021. And this is the fastest that stock trading has grown in the last decade. And it makes sense. I mean, the US government has printed over $6 trillion into the economy, giving money to everyone, whether you are rich, poor, or middle class. And I'm left to assume that the people who did not necessarily need the money invested it into the stock market. But a lot of these new investors will be shocked once they get their tax bill in 2022, because trading stocks has some massive tax consequences. So in this video, what I want to do is help people who are new to stock investing or consider themselves to be a beginner when it comes to stock investing, which to me is anyone who has been investing less than 3 years should consider themselves to be a beginner when it comes to stock investing. I want to help you understand the tax outcomes when it comes to trading stocks. Stay tuned. Hey there, and welcome to our channel. I'm Sean with Life Accounting, the accounting company that saves people from high taxes and low profits. Listen, if you find any value throughout this video, please support us by hitting the like button for the YouTube algorithm and subscribe to continue growing your wealth. All right, let's dive in. So, since about mid-April of 2020, stocks have been on a tear. It seems like no matter what you invest in, the stock has been going up. In fact, since August 16, 2021, the S&P 500 has doubled from its pandemic low, making it the fastest bull market since World War II. Hey Sean, look, I can grow as fast as the stock market. Okay, so that means millions of people stand to make a profit if they sell their stocks. But it's important for new stock investors to know that number one, any gains they make on stocks is still considered to be taxable income. And many people don't consider the profit after tax because most trading platforms and apps only show you the profit before tax. And when you get to the place in your life when you have become a stock investor, you cannot put your head in the sand when it comes to taxes without consequences. All right, so let's say, for example, that you are a high income earner and you're somewhere within the 24% tax bracket. So you decide to go out and invest $1,000 into stocks. And 10 months later, your stocks have doubled from $1,000 to $2,000 in market value. So you're maybe thinking like, awesome, I just made $1,000 in profit and I'm gonna sell it right here. And sure enough, you get the $1,000 deposited into your bank account, but then in 2022, you get a statement showing that you made $1,000 profit and you have to pay taxes at that 24% tax rate. So suddenly your $1,000 profit turns into $760 profit after you subtract the $240 that you paid in taxes. But okay, right? $240 in taxes is not a big deal for most new stock investors. But if we stick with that example, let's say you made $10,000 in profit. Now you're looking at paying $2,400 in taxes. And this is where one of the biggest mistakes come into play for new stock investors, because I've seen people who would take the profit that they gain from stocks and then make a purchase like getting a new car or buying new stocks, only to later get stuck with an unexpected tax bill the next year and struggle to pay off the expense of that new car or that new stock in the tax bill. Now, really quickly, I have to touch on this. Okay, so these profits that we just discussed are also referred to as capital gains. And you should know that there are short-term capital gains and there are long-term capital gains. So short-term capital gains are stock profits that you have that occur in less than 1 year. And these short-term gains are taxed at your ordinary tax rate, which is based on your current tax bracket. So usually if you are a high income earner and you are playing around with stocks a lot, like you're always buying stocks or you're always selling stocks within a year, then you have the greatest risk for poor tax outcomes. On the other hand, you have long-term capital gains, which have their own long-term tax rate, which is usually somewhere around 15 to 20%. Now, it is very important for you to know that you only have taxable income once you sell a stock. So if you decide to hold a stock over a long period of time, you won't have any realized profits or realized capital gains. Now, we have an entire video breaking down what capital gains are, which I'll link up above. All right, now let's go ahead and talk about some ways that you can mitigate this unexpected tax bill. But before I do, if you are a new stock investor, meaning that you've been invested for less than 3 years, then tell us in the comments section below. And while you're at it, go ahead and share with us what stocks that you own. Okay, so let's get back on track. So if you're watching this and you realize that you're going to have an unexpected tax bill, let's go ahead and talk about what can you do. Now, there are a few ways that you can offset what you'd owe. One way is through tax loss harvesting, which basically means that you're going to be selling a stock at a loss so that you can offset the gains of another stock. So if you do have a stock that is performing really bad, which is somewhat rare in this bull market, then you can get rid of it while you offset any of your other capital gains. The second thing you can do is donate your stocks to charity. Now, this one admittedly is a little bit advanced, but basically what you could do is pick a few stocks and then give them to a non-profit. And with that, you don't have to realize any capital gains, and you could actually end up with a tax deduction depending on your tax bracket and if you actually itemize on your tax return. And if you're super advanced, that stock that you donated can go to a nonprofit that you directly manage, which also gives you a lot of great tax benefits as well. And if you want to learn how to start and manage a nonprofit, I'll link a video somewhere up above or in the description below. The third thing you can do to mitigate the capital gains that you have is by selling them during a year where you had a loss. So let's say, for example, that you own a depreciating asset or you run a business, and during that tax year, you are reporting a loss, meaning that you basically won't have any taxable income. Then this is a good time to actually sell your stocks, get your capital gains, because you're gonna be in a very low tax bracket and be able to minimize the actual gains that you pay on your stocks. And lastly, if you are looking to avoid paying capital gains tax in the future beyond just 2020, then you should consider investing through a retirement account such as a 401k or a Roth IRA. Okay, these types of retirement accounts won't incur any capital gains taxes as long as you hold them until retirement age. So if you do happen to take a profit before you reach retirement age, then you could end up paying penalties on top of those taxes. All right, now those are just 4 quick ways that you can mitigate your tax bill, especially if it's unexpected. But as accountants, we are always talking about ways that you can reduce your taxes. So if you want to learn more about what you can do to reduce your tax outcomes, maximize your profits, then make sure you subscribe to our channel. Now look, at the end of the day, capital gains are a good thing. It means that you picked a profitable investment and you're walking away with more money than you started with. And that's the whole point of investing. So you just want to make sure you're keeping in the back of your mind the tax outcomes, okay? And you'll find yourself in a great position. All right, well, that's it for now. As always, thank you so much for watching this video. We have 2 more coming up next, and we'll see you over there.